Why settle for stagnant money in the bank when you can let it grow while you catch some Z's? Investing has its cheerleaders, but taking that first step can feel like stepping into a fog. What to invest in? How to ensure a win? Fear not! This guide is your flashlight through the investment maze, revealing options and beginner-friendly tips. If you like videos like this, make sure to drop a like, hit that subscribe button, and turn on that notification bell. Before diving into investing, beginners need to grasp the fundamental concept. This understanding sets the stage for informed decision-making. Without a clear grasp of investing's basic premise, it's challenging to make strategic choices that align with financial goals. Number 1. Understanding investing. Investing means putting your money into various avenues with the aim of gaining a financial return. Essentially, you're using your money to generate more money and achieve your financial goals. Regardless of where you choose to invest, it involves entrusting your funds to companies, governments, or other entities in the hope that they'll generate more money for you in the future. People invest money with specific objectives in mind, such as retirement, education expenses, or buying a home. It's a distinct from saving or trading, often involving a longer-term commitment, and it comes with some level of risk, unlike saving. Number 2. Diverse approaches to stock market investment. Knowing different investment approaches helps beginners find their comfort zone. This knowledge empowers them to make choices aligned with their expertise, risk tolerance, and time availability. Individual stocks. Investing in individual stocks means purchasing shares of a specific company's ownership. This approach requires significant research and analysis to identify companies with potential for growth. If you're ready to put in the time and effort to study company financials, industry trends, and market dynamics, you can select individual stocks that you believe will perform well over time. Successful stock selection can result in higher returns than the overall market, but it also involves higher risk due to the concentrated nature of your investments. Index funds. Index funds are investment funds that aim to replicate the performance of a specific market index, such as the S&P 500. These funds provide diversification by including a broad range of companies within the index. Since they passively track the index, they require less active management, which translates to lower fees. Index funds are popular among investors seeking consistent, long-term returns that closely match the market's overall performance. They offer a way to participate in the broader market without the need for in-depth stock research. Robo-advisors. Robo-advisors are automated investment platforms that use algorithms to create and manage portfolios based on their personal information, risk tolerance, and financial goals. They use a combination of exchange-traded funds or ETFs to build a diversified portfolio. Robo-advisors are suitable for those who prefer a hands-off approach to investing. They provide convenience and professional management without the need for constant monitoring. Additionally, they often offer features like automatic rebalancing and tax optimization. Number 3. Determining your stock investment amount. Proper allocation of funds is crucial to managing risk and achieving goals. Beginners often have limited experience with market fluctuations. Learning about short-term risks and asset allocation guides them in avoiding undue exposure to market volatility and helps them plan for both short and long-term financial needs. Short-term risks. The stock market can be highly volatile in the short term. Prices of individual stocks and the overall market can experience significant fluctuations within a short period. This volatility can lead to substantial losses if you need to access your funds in the near future. Therefore, money you might require within the next 5 years should be kept in more stable and liquid assets, such as savings accounts or short-term bonds. Asset allocation. Asset allocation involves deciding how to distribute your investments among different asset classes, such as stocks, bonds, and cash. Your asset allocation strategy should consider factors such as your age, risk tolerance, and financial goals. While stocks have the potential for higher returns over the long term, they also carry higher risk. As you age, you might gradually shift your allocation away from stocks towards more conservative investments like bonds to preserve capital and reduce risk as you approach retirement. Age and allocation. The 110 minus age rule simplifies the process of determining the ideal allocation between stocks and bonds. Subtract your age from 110 to estimate the percentage of your portfolio that should be allocated to stocks. The rest would be allocated to bonds or fixed income assets. This rule provides a starting point, but personal circumstances and risk preferences might lead you to adjust this allocation. For instance, if you're comfortable with higher risk and have a longer investment horizon, you might choose to hold a higher percentage of stocks. Wait, before we proceed, let's take a quick breather. If you're finding these insights helpful, show your support by giving us a thumbs up and hitting that subscribe button. Now, let's get back to our guide and uncover more need-to-know information before you start your investing journey. Number 4. Setting up your investment account. This ensures a smooth and effective investing journey. Beginners need to understand the account types available to them and how those accounts align with their goals. Brokerage account. A brokerage account is a specialized type of account that allows you to buy, sell, and hold various types of investments, including stocks, bonds, mutual funds, and exchange-traded funds or ETFs. Brokerage accounts are offered by financial institutions such as E*TRADE, Charles Schwab, and others. Opening a brokerage account involves a straightforward process where you provide personal information, complete required forms, and fund the account. Account types. When choosing an account type, consider your investment goals. A standard brokerage account offers flexibility in terms of access to your funds, but it doesn't come with specific tax advantages. This type is suitable if you want to invest for purposes other than retirement. On the other hand, an individual retirement account or IRA provides tax benefits and is designed for retirement savings. Traditional IRAs offer tax-deferred growth, while Roth IRAs offer tax-free withdrawals in retirement. Depending on your employment status and needs, there are additional options like SEP IRAs for self-employed individuals or simple IRAs for small businesses. Comparing costs and features. While trading commissions have become less common, different brokerages offer varying features and tools. Some brokerages provide educational resources, research reports, and investment analysis tools to assist investors, especially those new to the stock market. Consider the user-friendliness of the trading platform and whether the brokerage offers customer support that suits your needs. Some platforms even offer demo accounts, allowing you to practice trading without using real money. Beginners are more susceptible to common investing mistakes. Learning about diversification safeguards against putting all eggs in one basket. Understanding business fundamentals and volatility helps beginners avoid rash decisions and make more informed choices. Number 5. Selecting stocks wisely. Diversification. Diversifying your investment portfolio involves spreading your money across different types of assets, industries, and geographic regions. This strategy aims to reduce the impact of poor performance from a single investment on your overall portfolio. Diversification can help manage risk and smooth out the ups and downs of the market. Understanding businesses. Before investing in a company's stock, it's crucial to understand its business model, products or services, competitive landscape, and financial health. Investing in companies you're familiar with can give you an advantage in making informed decisions. This knowledge helps you evaluate a company's potential for growth and its ability to weather economic challenges. Volatility awareness. Highly volatile stocks can experience rapid price fluctuations, which can lead to significant gains or losses in a short period. For beginners, it's generally advisable to avoid or limit exposure to such high volatility stocks until you've gained more experience and knowledge about market dynamics. Avoiding penny stocks. Penny stocks are low-priced stocks that often trade on over-the-counter or OTC markets. They can be highly speculative and risky due to their low liquidity and lack of regulation. It's generally wise to avoid penny stocks, especially if you're a beginner, as they can be susceptible to manipulation and fraud. Learning metrics and concepts. Learning to evaluate stocks involves understanding various metrics and concepts. Key indicators include price to earnings or PE ratio, earnings per share or EPS, and revenue growth. Value investing focuses on finding undervalued stocks, while growth investing seeks companies with high growth potential. Familiarize yourself with these strategies to make informed investment decisions aligned with your goals and risk tolerance. And that's a wrap on this investment guide. We hope you're feeling inspired and ready to make your money work for you. But before you go, we want to know which investment strategy has caught your eye. Drop your thoughts in the comments. And if you had fun, remember to like and subscribe for more money tips and tricks.